which is our morning update here at tradecaptain.com. We're going to take a look at these following markets, and the idea is to provide you guys with a live technical analysis and, in essence, my view on the market and what's going on. But before we start, as always, I need to stress that trading financial markets, unfortunately, is risky, and there's a risk that we'll lose our invested money. As well, we're gonna conduct live technical analysis. I'm gonna share with you guys what I think traders will be doing. It doesn't mean though that you should go out and necessarily do what I'm saying here, because trading, unfortunately, is very fluid. Today it could make sense to sell the dollar, but if Donald Trump says something tomorrow or in the next half an hour, it could be the opposite thing. And sometimes the market volatility is really low, and then again you have a big spike. Everybody's scratching their heads trying to make sense of things, so you need to bear that in mind. I have, however, of course, been doing this for numerous years, and I'm profitable myself in my trading, and I've been profitable since 2014. Before that, I did have, was trading stocks and actually mutual funds, and that wasn't that difficult either. But then, of course, I wasn't necessarily trading. It was more like a buy and hold. Anybody can be a winner in buy and hold. So what I'm trying to tell you, I know what I'm doing, and hopefully I can share some light on how the markets are, and hopefully I can help you with your trading. But again, no trading advice here. Okay, let's begin. Euro is close to the level seen yesterday, and without any correction, very few people are going to be interested to trade here. We need to either take out the low, which could potentially open up for further declines, but if you just look at this market, you get a low like this, up, and then similar sort of low. In fact, from this high, the market declined with about 237 pip, so it will be fair to have a bit of a correction. And to figure out how much the market can correct, one way is just taking Fibonacci from the trend defining level and the latest low, and then usually a 50% correction is what I prefer. Then you can just look at the charts. You see here, okay, you have this little structure here, and then you have sort of the structure here, and then you have a 1950, which is like a psychological level. So if this level doesn't hold, we might spike a little bit higher, but again, in this sort of range, we should look to assume that the market is going to roll over. Now, why is this my trend defining level? Well, if you look at the chart, even if you don't have to look at the whole big picture, but since April 18th, the market was trading here, and this is a large high, and then you have series of lower and lower highs, and the very short-term trend did actually end at one point earlier this week, but then eventually moved lower again, and this is the new level that is capping price. Because you see a trend many times, the way it works is it's gonna be very aggressive like this, and then it tries to take out the very short-term aggressive downtrend, and then it goes down, and then sometimes it just goes up again, and then it goes lower. But the whole idea here is that we're still creating these lower and lower highs. It's just that the intensity of the downtrend is not there any longer. So anyway, this is the last major high. It's not rocket science, and the trend is bearish below that level. When we derive profit targets, we just look to your left and see, do we have any relevant lows? Well, yes, we do. We have the December 17th, the December 12th low, and then you have another low down here, which is the low from November 2017. And these are potential targets. Okay, so first target though, December low, and that's it. Here's Bitcoin, and Bitcoin as well is short-term bearish. The market created that high over here, and then it created this high here, and we started out a few days ago. The market was creating higher and higher lows, took out that low, that turned, because we stopped creating these higher lows, that turned bearish. Then the market moved up, but I said as long as it stayed below this high, let's be bearish. And then yesterday, when we had confirmed that this was a new low as the market traded the downside, we said, well, this high here, which is the May 7th high at 94.46, is the new trend defining level. Now, I could lower it again and put it down here, and short-term scalpers are probably just watching this high. However, this is a bit of a volatile market, and it's never too good to be close to all the price action unless you want to be stopped out too often. So that's why I prefer sometimes I prefer not to be at the nearest high. Rather, I be using the high that is, well, the next following high, which is the one up here. Now this, of course, I think if it goes to the downside, and specifically if it touches the April 17th low here, which is the target of this bearish position as well, then yes, we'll lower the key level down here. And then we'll see. I mean, if it trades below the April 17th low, I think the market could probably target this sort of next high here, which is the, let me see here, this thing. I'm not sure if I should double click or single click. This is the what is it? April 7th high. April 9 high. So that could be the next target. And then we'll see what happens. This market is trading in this big wedge and it's fully normal. Following massive move and then correction, you'll have consolidation. And unfortunately, I don't wanna ruin the party, but this market from 2015 it rallied. Following such a rally, the market just needs to take a rest. The same way as we do if we have a big party, you know, we sleep for we'll try to catch up on sleep, right? Or sleep more hours, especially say you go out on Friday, sleep away all Saturday, more or less. Here again, sort of another example. The market bottomed out here in 2012, and the market moved up with 50,000%, and then you had, in this case, you had a big decline, and market actually quickly turned around, but you still had like a year of decline. Not saying all of 2018 is going to be wasted, but most likely it's going to trade more sideways here for longer. Here's Crude, and Crude is trying to take out that high. It's still really early. It's 9 a.m. With 11 minutes in London, so we could easily take out that high. The market could push to the upside, and we could potentially reach 73.25. Now, this is more of a scalp. You could potentially get involved if you want to, looking to make maybe 127 pip, but your stop loss is going to be here at 172 pip potential loss. Well, at least that's what I think the market is going to put their stop loss, so they're scalping. So the risk-reward ratio here is not necessarily optimal. What else can you trade if you like Crude? Well, in the technical analysis section, I did upload a setup yesterday, which is Euro CAD and Euro or Pound CAD. So you can see here how Euro CAD is clearly bearish, much like the Euro dollar. And obviously you want to look for a pullback, maybe 52 or something like that, and just being bearish below 53.15. The next support level is December 29 low. As well, I talked about Pound CAD. Price took out support here, and as I said yesterday, as long as it's trade below 74.08, I think this market can continue to trade to the downside. For more on this, just check out the technical analysis section here. As well, don't forget to check out the setups here by Nathan. Now, the next market we're going to cover is going to be gold. Gold, we communicated it well for a long period of time, and the idea is that if we took out this level, we're probably going to continue to trade to the downside. I assume we're going to continue to move to the downside, so I think we're going to go down. I think if we do go out to the May 1st low of 1,301, then I do think traders going to sell, and I do think most stop loss orders are still up here at above the 11 May 11 high. I think eventually, when we create a new high here, lower high, or if we sort of spend time here and then sort of this becomes a new high, we can probably lower the key level to this level here. But for now, it's just way too early. And here's the DAX. DAX is unfortunately a bit boring, and there's not too much to do about it. I see two opportunities. Either we have a break to last week's high that could give us a little bit of a scalp. I think most people, what they do, they buy the break, put a stop loss just below the low, so you risk about 146 pip, and then if it heads to the upside, it's actually not that difficult to make that return back, and this scalp could potentially provide a very good setup depending on how fast this market moves. So you would risk, you could potentially make 328 pip in a period of a few days by risking 148 pip. So 328 divided by 148, that's 2.2 times the risk, which is a very, very good solid risk reward ratio. Any issues here, of course, is the fact that this is a very sluggish market. So what you want to see is you want to see a break, and if it does quickly just move to the upside to the January 16 low, then that would be a good indication, and then one can relax a bit and say, okay, let's keep it. If not, it could just be up a little bit and then goes down lower, and if closes below this level, it's not necessarily a false breakout, but again, a bit of a warning sign that that may not work out. The alternative is the one I've been telling you guys over several days, which is just wait for a little pullback to 12,874, and because I think down here, I think traders will be looking to buy with stop losses just here. Okay, so those are the main markets we cover here. We're gonna check now if there's any questions or anything in the chat box. But I wanted to remind you guys that we have a webinar coming up. So Nathan's webinar was pushed forward to May 22nd because he was really ill earlier this week, and he was bedridden and could in essence just not come to the office. So he's doing this on May 22nd, and now Nathan used to trade for a hedge fund for about 4 years time, and he's gonna tell us a bit about that in another webinar on May 30th. But on May 22nd, he's gonna tell us some of the sort of trading discipline processes that he worked with when he was trading for this hedge fund. And as well, I'm hosting a webinar on May 29th, which is introduction to blockchain. So blockchain that everybody talks about, and Bitcoin trading or cryptocurrency trading in general, and that's happened on the May 29th. And with the cryptos, you can now trade cryptos with Amana Capital. So you can trade Bitcoin, Ethereum, Litecoin, and Ripple, and they work like any other market. The benefit here, though, is that you trading. It's good for trading because you're trading a CFD. So the good thing with trading with a CFD broker like Amana is that they're regulated. It is definitely possible to trade with, brokers, but Coinbase is not regulated. Kraken is not regulated. Binance is definitely not regulated. In fact, Binance, you can open up an account with just your email, and as long as you have Bitcoin, you can trade with Binance. So that's sort of very, very, I mean, that will be something they're going to shut down one day, just because the governments hate this. Because you can, in essence, as long as you have Bitcoin, you can send that to them, and obviously because they only deal with cryptocurrencies, they don't bother with money laundering and terror financing requirements. But I'm not saying the regulators are gonna come down off them now, but it's something that is probably not sustainable in the long run. And with a CFD broker, you don't have those issues most of the time if they're regulated, like in this case by the FCA. And in fact, if you trade Bitcoin and then Bitcoin disappears overnight, if you just trade on an exchange, you have nowhere to complain. Here at least you can complain to the financial ombudsman or the FCA directly, and they'll probably gonna force Amana and other CFD brokers to give back whatever the client had on his account, because you're trading the actual price change, you're not actually trading the underlying asset. Okay, enough about that. Good morning, Juan, and good morning, Mr. Respond. If anybody has any questions, feel free to send them over, and as well, if you're watching the presentation, don't forget to hit that like button. Just click here and then hit that like. As well, if you guys follow me on Twitter, I guess most of you guys do, but if you don't, if you're new to this, then don't forget you can follow me on Twitter at AlexFX00. So got a question here. Do you think the dollar is stretched? What's my view in the short term? I think that the dollar index is a bit stretched. So I can show you the dollar index. So this is the dollar index, and this is the daily chart. And you can see here how the market went from trading sideways to having that bullish breakout. And it just went straight. And usually when we hit these sort of highs, as you see here, the market should look to roll over. But it didn't. And like if you just trade this on the back of this daily chart, then it's not a good opportunity to buy. Why? Because you're about 2.2% from major resistance, and you are 4.38% from major support. So the risk reward ratio here is not good. So even though you could be right, and this continues to head to the upside, is something, if we do this for a long period of time, it's not good for the health of your account. Unless, of course, you have some sort of system that knows that, well, this very likely that we're going to head to the upside. And then you, because it's so likely it's going to head to the upside, you're happy to take on a position. You're risking quite a lot to make relatively less. So from that perspective, this market is definitely stretched, and we can just look at the charts, and it's close to the highs. So what can make it less stretched? Well, if you take a fib from the low, so if we assume that this market has genuinely turned bullish, then we take fib from this low. You have these 3 fibs, and maybe around 50% correction, it will be a good opportunity to look to rebuild a long position and then target the high. That will be also the most natural. After such a strong move, then probably down and then up again, and then we'll see what happens. Because if you follow the weekly, like if you follow this weekly chart, I know everybody's super excited about the dollar, and you have all these macro fundamental reasons to be bullish the dollar. But if you look at this weekly chart, well, is it really bullish any longer? So the multi-year trend here is not bullish, because this is a lower low, reference to this low, and this is just a lower high in reference to this one. So most likely, if you would trade the weekly, you would treat this as bearish. So people that would hold positions, because this is a whole year, by the way. So people that trade in that perspective, so 6 months, 9 months from now, they would probably sell here, and then they will look for this to go to the downside, and then they would see if we take out this low or not. And about trade, like time frames in general, sort of how far should you look? Well, it all depends on your investment horizon. So this is data from 1986. So of course, if you want to make a decision on what might happen with the dollar in the longer run, then yeah, you might argue it's still some sort of a multi-decade bearish trend to some extent, a bit sideways. And if you look at it from this perspective, maybe this was just a high like this one, and then we should potentially move lower. Maybe we need to be trading down here at 89 if you look at it from this perspective. Now, you might ask yourself, why could it be like this? Well, inflation in the US is at 2%. Inflation in Europe is at 1.2%. So the euro is 1.2% less worth today than it was 1 year ago. In the US, the dollar is weaker by about 2%, depending on the measure. So your dollars buys less stuff in the US than it did 1 year ago. And it's the same with the euro, but who kept its value better? The euro did. And in fact, the euro over the last couple of years have had what? Very low inflation. So the value of the euro has maintained itself over the last 2 years. So, well, the dollar in general has had higher inflation. If you think about it as well, if you check out the dollar yen, the dollar yen at one point used to trade at 200 and, well, actually moved back enough, 302. And it went all the way down to 80 or 77, and they still struggle with low inflation. But from that perspective, the Japanese yen is maintaining its value. Most likely you can buy the same sort of groceries and food today that you could do, I don't know, 10 years ago or something like that. That's not the case in the US. So from that perspective, maybe this should be trading at 75. Now the problem with those sort of analysis is that none of us is going to hold a position for 20 years or 10 years. I mean, most of us don't even hold positions for a day. The average retail trader trades about 3 times a day. I try to hold positions. It's not that I want to hold positions for a longer period of time, but I will hold positions for a week or two. If it's cryptos, well, it depends really. It could be up to a month. So in regards to time frames in general, sometimes it's not even worth it looking at it weekly, but you can look at it daily and 4 hour. 4 hours is usually good for most people. You're welcome, Juan. Yeah, so you have those different models. The short-term model is which central bank is raising interest rates, buy that currency and sell the currency of people that are doing quantitative easing or cutting interest rates. In the longer run, just looking at relative inflation is usually enough to explain what's going on with the world of currencies. Cool, guys. Have a good day, and I'll see you guys tomorrow at 9 a.m. London time. Again, don't forget to hit that like button if you like it as well. Don't forget to retweet, and if you have questions as well, you're most welcome to reach out here either via messages or just tweet to me. Have a good day, guys, and I'll see you guys tomorrow same time here at London FX. Thanks.